That's the way to do it, really, is to make sure that you don't have a reason to stop because you got to push through to the finish line.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome back to the Two Traders Podcast. Walter Peters here, and I have Darren. Hello, Darren, on the line.
Hello, Walter.
All the way from the miracle of the internet, all the way on the other side of the world, Darren. So I don't know why I added that in. I just thought it was funny. So we're talking about, before we hit the record button today, we're talking about small accounts and trading them really aggressively. And the reason I read this interview of a trader, and he was talking about how I think he actually traded for a fund or was involved in some fund or something. But the point is, he said, look, this is what we do is we'll trade quite conservatively. And then if we build up some profits, we'll take like a large chunk of those profits and we'll break it off into a smaller account, right? And then we'll trade that really aggressively. So like they don't even care. And actually, to be honest, I've done this as well. I used to trade with a trader who was really good, but he would make money upon money for months and months and months, and then he would just completely blow up. And so we did the same thing with him, where we would just basically give him a small amount, like a 1-2% amount of the available funds, and we let him just go for it, right? And he would build it up, and we pull it out, knowing that sooner or later he was going to come back with his tail between his legs. So that's kind of the thinking here. It's not a new idea, but I love to get your thoughts on this idea of having a small account that you break off and you trade completely differently in terms of money management or position sizing than you would to like a quote normal account.
Yeah, I think that's smart, and I think both ways, both trading conservatively and trading aggressively, can both make money. You just need to understand that there's different risks involved with both and different potential returns involved with both. And I think most traders start out trading a small account aggressively. I think most of us start out that way. And I think really you need to pinpoint how you want to trade and what your long-term goals are from trading, and then adjust how aggressively you trade accordingly. I think the danger comes is when people start out as a beginning trader that perhaps have had a good job or had a windfall and lots of savings, and they start with a relatively large account trading aggressively before they really understand the risks involved, and then they lose a lot of money and put themselves in a bad place.
Yeah, and all you really have to do is go to all you really have to do is go to like the free forums out there, like Forex Factor or whatever, to see this in action. It's not.
Yeah. And I think both can work. I think you really need to kind of find a bit of a middle ground, and you kind of need to find. You really need to find out exactly what you want to achieve as well. If you want to make $1 million in a year and you're trading really conservatively, it's almost impossible for you to achieve that. So you kind of have to marry your wants and beliefs into it as well.
Yeah, and accept the risks. So if you're going to trade, like a safe F or an optimal F, and I can put in the show notes, I can put the formulas or references for those, but if you're going to trade something like that, you got to mentally prepare yourself. You got to say, okay, this account can go to zero. Like I can lose all this money, right? But I'm saying, look, the risk, if I'm trading 3% of my normal account in this small account, knowing that, I have this pie in the sky goal, and working out the math and knowing that, yes, I have an X percentage chance of it all going bad, but I also have an X percent chance that it's going to work out. And really what it comes down to, and I can give the listeners access to this spreadsheet if they want, because I always found this to be quite useful for me. What it comes down to is really the sequence of winners and losers. In other words, how lucky you are. And if you start out really lucky, and you're really aggressive with your position sizing, that means you can build up a nice little cushion, and you can get going all right. And if you start out unlucky, especially when you have a small account like that you're trying to build up, it kind of stinks because it takes some time to get out of that hole. But either way, you're going to run into a drawdown. Either way, you're going to probably have, even with a high win rate system, if you're very aggressive with your lot sizing, you're going to run into some rough patches. So my number one advice for people when you do this is you got to prepare yourself mentally, and you got to look at execution and pay off execution, attend to execution. It's almost like you just want to just play the game, play the game to the end. Is the account at zero? Okay, I'm still trading then, that sort of thing, instead of trying to adjust on the fly. I think when you adjust on the fly with this sort of approach, I think that's where you run into trouble. I think you really need to set the rules up in the beginning and just go for it.
Yeah, definitely having a plan is important. When I started out trading, I didn't really have a plan. I just decided, well, that's kind of how much I want to risk on each trade. I hadn't done any calculations and you didn't really understand the probabilities. And to be fair, I was just kind of getting used to the whole process of trading at that time, really, rather than looking behind and sort of planning out, making a plan, if you like, for the longer term. And, I think in general, the advice out there is to be too conservative, and I think a lot of the time that advice comes from people who've been traders for banks or prop firms, and they've been basically told this is how you trade, this is how much you risk, and then they're giving advice to retail traders, and it doesn't necessarily translate perfectly from that world to the world of retail trading. So I don't agree with being uber conservative, but at the same time, you can say the same about being uber risky. You kind of need to find that middle ground. And it does feel kind of good when you do get it planned out, and you tend to deal with your drawdowns much better and your losses much better, because you have a better idea of really what to expect from your trading. So, you definitely need to plan it out. You definitely need to have realistic expectations.
Yeah, so exactly. Yeah, so the thing about this is, I think that here's a hint. Okay, if you're going to do this, I think sometimes what happens is people get really gung-ho on a particular system. And my advice would be, if you're going to follow this, think about trying to trade that small account quite aggressively with complementary systems, right? So maybe you're trading it with like a swing trading system and a trend trading system, or a breakout system and a reversion to the mean, or whatever. Because what we're trying to do here is we're trying to make sure that we don't run into a drawdown that kills the account, because that's the real concern. When you go this way and take this approach, what's going to end the experiment is when you have a drawdown that just completely obliterates the account. Now you can mute your returns, so they're not going to be as nice by trading complementary systems, but it's also going to mute your drawdowns too. And the key here is that they're complementary, so you don't really want them to be correlated, or you don't want them to work really well in the same type of market. And I think traders get into trouble when they think that they're gonna do this, what I just said, by trading different markets or uncorrelated forex pairs, currency pairs, because that doesn't really work as well. So we saw that, and I don't know what you were trading today, Darren. Like there was a kind of a weird move on the euro, and that might have caught a lot of people today. As the day that we're recording this, there's kind of this weird spiky move on the euro, and that might have caught some people. But that's the thing, that means that all the euro pairs had that spiky move. The euro pound, the euro Aussie, the euro Kiwi, all of them have it. Just looking at the chart. So that's not something that I think you can get away with. And a lot of traders think that the markets, different markets are going to save them. No, it's really the systems, I think, that you should be focusing on. So if you're going to if you're going to use this approach, focus on execution, mentally prepare yourself, and try and see if you can get complementary systems involved so that you can mute your drawdowns.
Yeah, I've seen that. I've seen a really similar approach where the same entries on the same instrument, but different exit strategies. So one would let his trades really run with a much wider sort of trailing stop, and one would be more aggressive with the trailing stop. So when the market isn't moving so well, exit B would perform better, and when the market was really perfect, then they'd both perform well. and it just kind of muted those drawdowns, like you say.
Yeah, exactly.
And I did get caught in the euro today, the euro yen.
All right, euro yen. Okay, yeah. I saw that on the euro because I have like a longer term trade on the euro kiwi, and I saw that move, and then I saw some people were talking about it, and I thought that was, when I heard you mention that. I don't know if you mentioned it in the last podcast or if it was in this podcast, but I heard you mention about the trading. Yeah, so I figured that would be the case. But that's the thing, like, the fact that, I wasn't even looking at the euro yen. I was looking at the euro kiwi, the euro Aussie, the euro pound, and the euro, and I saw the spike, and yet, obviously it happened to you on the euro yen.
I think that whole switch into different instruments is generally a bit of a curve fitting thing, isn't it?
Yeah, exactly right.
You'll see the Aussie dollar moving really well, and you'll jump to that, and then the instrument you were trading starts to move well, and so you just kind of end up chasing your tail. Okay,
well, I don't really have much more to add on this. I've kind of shot my bullets on the small account thing. It's really all about being, really mentally prepared, trying to trade different systems that are complementary, that don't do well in the same market, and focus on execution. Just one of the things, like, I don't know if you know the story, Darren, about Larry Williams, and you probably heard the story about Larry Williams. Well, he entered a contest back in like 1981 or something. It was a futures trading contest, and to be honest, I don't know much about Larry Williams. Like, I haven't read his books and things like that. I know he has some books out there and stuff, but what he did was he took I think it was a $10,000 account up to $1 million or something like that over the course of a year. It was something like that. So that's 10,000% return, right? Yeah, but what's interesting is that it was actually up to like almost 2 million, like 1.9 million or something like that. And he was actually in a drawdown at the end of the year in December when the contest was over. And he actually said, when he was doing this, and the reason why he was able to do this was because he had worked with Ralph Vince, the guy who came up with the Optimal F, and he told Ralph, he said, "Hey, Ralph, you tell me, like, I've got my systems here, but you tell me how much I should be trading on these systems. I want to win this contest, right?" And so that's basically was kind of the birth of the Optimal F, was through that. And so, but what was interesting to me is that he was actually up like, 19,000% and was in a drawdown at the end. And he even said, I knew I was going to win the contest. It was clear, like, 4 or 5 months into the contest that he was going to win it. And he said, well, should I just stop or should I keep going? He's like, no, I'm a trader, man. I'm going to keep going. So he did that too. And he lost, in the last month and a half or whatever, he lost another, 40, 50% of his gains. And even though he ended up with this, record-setting performance, it was actually half of what he had he had stopped, trading, just before that. And that's the kind of thing you should expect to see if you're going to do this. If you're going to do this, expect to see the 70% drawdown. These are the sorts of things you just have to keep going. Yeah, and just keep chopping. Don't stop. That's what you need to do. Just keep going. And that's the critical thing here, because in a normal account, you might go, well, I'm down 30%. It's not working. Time to reassess, change, whatever. But in this sort of a situation, you really just need to, I believe, for me, just go until it's either, you can't take another trade or the timer's up. And that's another thing. Like, you can set a timer on this. You go, I'm going to do it for a month or 6 months or a year or whatever it is. And then you can allow yourself to take a rest and reassess or whatever. But, maybe that's the way to do it, really, is to make sure that you don't have a reason to stop, because you got to push through to the finish line. That's another one that I would probably say. Yeah.
Yeah. I think really most people, when they start out trading with a small account, are going to trade aggressively anyway, regardless of what we or anybody else says. I think most people do that. And it's probably a good way to start, because one, you can't lose too much money, presuming it is a small account, and that's not a significant amount to you. And two, trading a small account aggressively will teach you a lot. It will teach you some important lessons, and as long as you pick up on those lessons and then use them going forward, you might lose $2,000 or $3,000. But if you want to be a trader long term, you might well pick up some really important lessons.
That's a great point. And if you read the Market Wizards book, they all basically have learned lessons that way, haven't they? They've all kind of come from
I think we all have, haven't we?
Yeah. Oh, yeah. Absolutely. Absolutely. Oh, yeah. Absolutely. From learning that, okay, I don't want to have that feeling again. So it's like avoidance, motivation via avoidance. I want to avoid that feeling and I want to avoid that situation, so I'm going to do this instead, that sort of thing.
As long as you can pinpoint exactly what happened and why.
Yes.
As long as you can learn the lesson.
Exactly. Yeah, and your guy Taleb, Nassim Taleb, he did that too, because his mentor, Victor Niederhofer, his mentor was basically writing these naked options, so that he was making money every day, and then one day he owed all this money and he didn't have the underlying asset, so he would go broke. And I know Niederhofer's basically gone broke at least twice doing that, and rumored to be 3 times, but that's just allegedly. I mean, that's out there on the right. But so what does Nassim Taleb did? Taleb, for those of you that don't know, it's fair to say, Darren, you're a pretty big fan. I'm a pretty big fan of, you're Anti-Fragile, The Black Swan. So these sorts. There's another one too. I haven't read. What's the other one? There's another one. There's another trading related one. I'll put it in the show notes, but there's one, Fooled by Randomness. Yeah, that's the other one. So, but what did Taleb do? He did the opposite. Taleb takes a trade every week, every day. He's like, okay, he's going to lose money. He calls it the bleed system, right? And then one day he wakes up rich. Because the market's completely, there's a crash or whatever, right? So that's when he makes all the money, but no one sees it coming, and that's kind of the whole. So he took what his mentor did, what he learned from trading, and he said, "This guy's crazy. I'm going to do the opposite," and it works for him. So that's another way of seeing, avoiding what happens to you when you trade really aggressively with a small account. Avoiding what you see other traders do because you think, that why would they do that? That's another way to define yourself as a trader, is to see what you don't want. So that's a really good point too. That's a wrap. Well, thanks so much for the time, Darren. And we'll see you in the next episode. Thanks, guys, for your time.
Okay, thanks, Walter. See you soon.
See ya.